Hey Harvesters, and welcome to Project Premium Harvest. My name is Matt. In today's video, I'm going to be going over the options trading I've done for April 24th, 2025. We're going to talk about my wins, my losses. We're going to go into detail about how I selected my covered calls for the S&P 500. And then we're going to talk about the considerations I have made for my cash secured put. We're going to talk about how much premium. We're going to talk about how successful this options trading strategy has been going since I've transferred over from high income ETFs. I've been trading options for 9 days now, and we're going to make a determination. Is this better than investing in the high income ETFs? Let me know in the comment section what you guys think. And then lastly, we're going to talk about how we're going to trade tomorrow with how the market condition is looking, and then we will go from there. So let's get started. You guys know me. The first thing I like to talk about on my account is my account value. Account value is at $88,705.60. Let's go over the spreadsheet, and then we're going to discuss all about the option strategy and tactics. For April 24th, I made $455 of options premium. So let me dive into details of what actually happened. So the first thing that I did is I bought 100 shares of SPY when the market opened. Market opened at the 536.74. I was able to snag them at about 536.25. So I immediately, once I bought these 100 shares, I didn't necessarily know if the market was going to go up or going to go down. So for me, I just wanted to lock in premium at the buy-in price. So then I chose a 537 strike price. Yep, I did a 537 strike price. So that netted me a premium of about $278. And the reason why I did at the money is I didn't know if the market was going to go up or down. So if I had locked in at the money, I would be guaranteed that $278 of premium. And if it went down, cool, I get to keep the shares, and then I made a good amount of premium. If, on the other hand, the market went up, I would get a little bit of appreciation, not as much as I'd want, but I still guaranteed $278. So for me, after having a bad trade a few days ago, this was like the best option for me on this Thursday. I didn't know where the market was going to go, so I wanted to be as safe as possible. Bought in at this price and lock in a little bit of premium. That's the route I took. And then because at the end of the trading day, the S&P 500 was like blew way past my at the money mark of the 537. I think it was at 545 when the market closed, and I think it's S&P 500 is currently trading at the 550 right now. But with me choosing that 537 strike price, I also made $75 in appreciation when I got my shares assigned. And then lastly, the third leg of what I did today was cash secured puts. With the same thought process of I didn't know if the market was going to go up or down, I wanted to buy SPY at a discount. And since it was when it opened at the 536.74, I was like, if I can get this at a $5 more discount and someone pay me for it, that's a win-win in my book. So then I bagged another $102 running a cash secured put. I chose the 530 strike price. Obviously didn't hit because the market was going up. But if it were to go down to 530, I would have no problem at all getting these shares assigned, turning it around, and then running options that are like $5 to $10 out of the money. So that's what I did, guys. Looking at this daily tracker, guys, after adding in that $455 gain today on April 24th, my total premium trading these last 9 days is $1,750.03. If we look at that as a win percentage, it's about 88.8%. Won 8 trades and lost 1. And just to kind of reiterate the point, so maybe not for you guys, but for me, so I don't make the same mistake again, is I'm going to continue looking at this big red number and remember what I did wrong, and then keep in my mind, if I see this kind of event unfolding again, what I would do to mitigate the loss. It's all about mitigation and ensuring that you can go green. I rather take a low amount of premium that's in the green than a big amount of red premium trying to shoot for the stars. All right, guys, but let's go over to Robinhood and then discuss what I plan on doing for tomorrow. Okay, now that we're back at Robinhood, let's go over to SPY. So right now, the market seems a little too overvalued for my liking. We'll see if Friday is going to be a red day, but it's definitely trending in an upward momentum, a lot of green. So therefore, when the market opens tomorrow, we'll make a determination if we're just going to run cash secured puts or if I want to buy in and then run covered calls. I think right now at this 549 is a little too overpriced for what the market is capable of. It's green today at 549. Next week, it might be back down to the 530s. I'm not necessarily going to risk that, so I'd rather just do cash secured puts. I might choose something at the 530, but let's actually look at the options and what it represents. So let's scroll down to, you guys know what I'm going to say here, the money printer button. Let's click on it. So what I plan on doing for tomorrow, so I'm just going to go over for anyone that is new and discuss what each option is. I'm going to explain covered calls. Basically, to run a covered call, you need to own 100 shares of an underlying. 100 shares is one contract. So to sell covered calls, basically all of this bid price and all these numbers here, if you were to have, for like example, like me, I don't have right now, but when I do have 100 shares of SPY, that's one contract. So one contract is going to net you this $1.18 over here, but you times that by 100, so it's actually $118. For selling a covered call, so the way it works for Robinhood, you have to click sell call. If you do buy, that means you as an investor are paying somebody else for the opportunity to buy stock at a certain price. So to run in the safest way possible, covered calls, you do sell call. When you do sell call, the way this works is to sell covered calls, you have to own 100 shares of an underlying. 100 shares is one contract. So say, for example, that the S&P 500 is trading at this 548.75. You want to choose something that's usually $5 or $10 away. That's kind of my fine touch point, except for today I was at the money. So let's do like 553. So you own 100 shares of SPY. You can run one contract. So an investor is going to pay you $1.18 per one of your shares. So at the end of it, it's going to be $118. And they're going to lock in this price. So if the S&P 500 goes at or above the 553, you're going to have to get your shares assigned. So those 100 shares of SPY that you own would get assigned to the investor that paid you the premium. So that's what happens if you hit at the money or above. If the share price falls short of that 553, imagine this. The investor, they paid you that premium up front, so you made that $118 up front. But then if your shares don't get assigned, then you can rinse and repeat this the next day. You can run daily covered calls on the S&P 500. You can't really do that with any other funds like NVIDIA, Oracle, Amazon. They're usually weeklies. So therefore, that's the one benefit of the S&P 500 or SPY. That's the one benefit of SPY is you can run daily covered calls. And usually that's my goal here is I want to buy in at a relatively cheap price, but I want to choose strike prices that aren't necessarily going to hit, but then also rack in premium so I can continue to maintain an income every single day. Cash secured puts, on the other hand, are a little bit different. So covered call, it benefits you if the price is going up and someone's going to pay you a premium. For cash secured put, it's a little different. For cash secured put, an investor is going to pay you money to lock in a price to offload their shares if the market's going down. So the way a cash secured put works, you have to hit sell put. And after you hit sell put, you have to decide at what price are you willing to purchase like the S&P 500. So right now it's trading at 549.08. I'll try to pick something that's $5 or $10 away from that strike price so I can get some shares at a discount. So I probably think of this 545. If it's trading at 217, I kind of want to lock in usually $100 a contract. So I'll probably scroll down a little bit further and maybe choose something at this 539 or 540. That's not necessarily what I'm thinking about doing. We'll see what the market looks like. If the market's going shooting down, I might hesitate towards buying a covered call until maybe there's like some point of resistance. Because I don't want to buy a covered call, or I don't want to buy a cash secured put and then at the 539 and then it blows down to 530. I basically have to lock in the S&P 500 shares at the 539. But the way the cash secured put works is investor pays you upfront premiums to offload their shares. So imagine you chose the 539. You have to have about $53,900 of collateral set aside. That could either be margin or your cash for you to execute this trade. Because if you don't have that money, Robinhood wouldn't be able to assign you the shares. So they're not willing to do that. So what happens is you have to have collateral set aside. But imagine this, investor pays you, $88 for that contract. You choose this 539 strike price. The market is at that 549.08. S&P 500 goes down to 541. It doesn't go below this 539. So guess what? That premium that investor paid you, you get to keep. But now let's say the roles reverse. So say that you bought this, you didn't buy it. Say investor paid you the $88 to lock in selling this S&P 500 at this 539. If at the end of the trading day, S&P 500 is at 539 or below, like 538, 537, you're going to get the shares assigned to you. So you're basically buying the shares from that investor that paid you that premium. And then once you have the shares, then you can do whatever you want with them. You can either sell them, run covered calls against them. If you want, you could even run you could run a put against it. But I wouldn't recommend it. But let's talk about the plan for tomorrow. So if I can potentially choose a price maybe this 539 or 538 for like this $88 or $75, I might execute on that. The likelihood of me running an actual covered call, like buying another 100 shares and then maybe running at the money, I think it's a little suspect. I think this price right now for the SPY is a little too high. I would like to see it go down. Yeah, guys, that's pretty much the video. There isn't anything that's screaming out at me that's like a great deal. So I might be I'm going to take it easy tomorrow. I might not necessarily go too hard. But if an opportunity presents itself, I'm not going to hesitate to take advantage of it. But I'm not liking anything that I'm seeing right now. I think SPY's trading a little too optimistically right now for the last couple of days. I might just try to lock in $50. Just keep it nice and easy. I had 2 wins in a row after a big loss. Let's just keep the ball rolling on a nice win at the end of the week. That wraps up the video, guys. Hopefully you learned something new. Hopefully this gives you some motivation into running your own options. I am so thankful that I stopped investing into high income ETFs, because then I don't have to deal with NAV erosion. I can pick and choose when I sell the options. It's a lot safer. There's a lot less NAV erosion, and I'm in the control of my own destiny versus somebody else. So therefore, there's kind of the pros for it. But then the cons is you always have to be on it. You always have to be looking out for trades. You always have to be cognizant of what's going on in the market. And you have to personally deal with all the fluctuations and reacting to the market as it comes. But that's the video, guys. Hope you enjoyed it. I will see you in the next one. Matt out.